If you're over 65, I want you to picture something that happens to millions of good, careful retirees every single year. It's not dramatic, it's not a scam call, it's not a crisis you can point to, it's quieter than that. It's the slow, automatic yes that happens when a bill arrives. You pay it because you've always paid it, and then you move on because you're tired and you don't want problems. The property tax bill, the DMV renewal, the Medicare premium that quietly rises, the state withholding, the surprise tax bill in April, the home sale fear, the medical bills you assume don't count. And month after month, year after year, the money leaves your life in little pieces that add up to thousands. Here's what almost no senior is told clearly. American tax law is filled with exemptions, credits, freezes, exclusions, and deductions designed specifically for older adults. Not as a loophole, not as a trick, as a policy choice. The problem is, the system doesn't come looking for you. The IRS doesn't call you to say, you missed the senior standard deduction. Your county assessor doesn't call you at 65 and say, your property taxes can be reduced if you apply. Your state doesn't call you to say, we don't tax Social Security anymore. Or, your income level qualifies you for an exemption. The bill arrives and the system assumes you'll either know or keep paying. Today we're going to talk about 7 common retirement money leaks, taxes, fees, and bills that many seniors pay at full price, even when they may be legally eligible to reduce them or avoid them. I'm going to explain what each one is, how it works, who it often helps, what the common mistakes look like, and what to do this month to check your own situation calmly. And please stay with me until the end, because the number one secret I'm going to share is the one that can reduce multiple leaks at the same time for the right person, federal tax, Social Security taxation, and even Medicare premium surcharges without changing your lifestyle. Most people never hear about it until they've overpaid for years. Before we begin, comment your age and your biggest struggle right now. Medical bills, prescriptions, rent, groceries, property taxes, caregiving, scams, retirement timing, whatever is weighing on you. Just write 72 prescriptions, or 67 property taxes, or 74 rent. I read those comments, and it helps me aim future videos at what you actually need. And a quick disclaimer, because I respect you enough to be honest, I'm a senior benefits educator. I'm not your tax professional or attorney. This is general information. Eligibility and rules vary by state, county, income, and personal facts. Before you change anything, verify with official sources like irs.gov, your State Department of Revenue, your county assessor, or a qualified tax professional. Now let's make this real. You didn't work 40, 45, 50 years just to lose your retirement to autopay. And I don't say that to stir anger. I say it because you deserve dignity. You deserve to keep what you earned. You deserve to understand the rules before someone else benefits from your not knowing them. The first and biggest tax bill for most older homeowners is property taxes, and this is where the largest savings often hide. Nearly every state has some form of senior property tax relief, but it rarely shows up automatically on your bill. It can take the form of a homestead exemption that reduces the taxable assessed value of your home, an assessment freeze that limits how much your assessed value can rise, a circuit breaker credit that kicks in when taxes are too high compared to your income, a deferral program that lets you delay taxes until later, and in some areas, special programs for disabled homeowners, veterans, or surviving spouses. The names vary wildly, and that's part of the problem. It's like every county invented its own language. Here is how it works in plain English. Your county decides what your home is worth for tax purposes, then applies tax rates to that number. Relief programs either lower the number they tax, freeze it, or give you a credit based on income. But, and this is the part that costs seniors real money, most of the time you must apply. You must meet a deadline. You must provide proof of age, residency, sometimes income. And if you miss the window, you often miss the savings for that year. Let me tell you about Barbara, age 68, because her story is what I want you to imagine when you feel tempted to say, it's probably not worth it. Barbara owned her home outright. She thought that meant she was safe. But every year her property taxes rose, and the increase was bigger than her Social Security cost of living adjustment. It felt like being punished for staying put. She assumed there was nothing to do. Then a neighbor casually mentioned a senior exemption. Barbara called her county assessor, asked what programs existed for seniors, and discovered she qualified for an exemption she had never filed for. After she applied, Her tax bill dropped by over $1,000 for the year. Barbara didn't become rich, she became stable. She told me, "It felt like I finally caught up to the rules. That's what I want for you." Now here's the second tax bill that's hiding in plain sight, and it catches even careful retirees. The additional standard deduction amount for seniors on the federal tax return. When you reach 65, the federal tax code generally allows a higher standard deduction amount through an additional amount for age and sometimes for blindness, which can reduce your taxable income. The exact amounts change over time and depend on filing status, so I'm not going to lock us into a single number here. The point is the mechanism. Once you qualify by age, your standard deduction can be higher, which means less of your income is taxed. How does this become a leak? Seniors often file taxes on autopilot. They use last year's software. They go to the same preparer. They assume everything is the same. And then a spouse turns 65 or a widow shifts to single filing status and nobody revisits the deductions carefully. The IRS processes what you submit. It doesn't call you to ask, "Did you claim the age-based amount?" If you're not sure, it is worth asking your preparer to review whether it was included in recent years, because in some situations, amended returns can recover overpaid taxes for prior years. Not forever, there are time limits, but long enough that it's worth checking. Now, the third tax bill is state income tax on Social Security benefits. This is where seniors get trapped by assumptions. Many states do not tax Social Security at all. Some states that used to tax it have changed their rules. Some states tax it but offer exemptions, credits, or income-based reductions that mean many seniors in those states owe nothing anyway. The danger is this: you see state withholding, or you see state tax on a return and you assume, "I must owe it." Maybe you do, maybe you don't. State rules change, and the system doesn't knock on your door when it does. Here's what this looks like in real life. A widow is filing taxes after losing her spouse. Her filing status changes, her income picture changes, and suddenly her state return looks different. She pays it because she's grieving and she doesn't want to fight. Then she pays it again next year because she assumes it's normal. But sometimes, if she had known to check her state's Social Security treatment and senior exemptions, she might have reduced that state tax or eliminated it. This is a perfect example of why one calm conversation with a knowledgeable tax professional in your state can pay for itself. Not because they have magic tricks, but because they know the current state rules and you don't have time to read the whole revenue code. Now, the fourth tax bill is one that scares seniors into making bad moves: capital gains tax on the sale of your primary home. I can't tell you how many older adults delay downsizing, delay moving closer to family, or stay in a home that's too hard to maintain because they fear, "If I sell, I'll owe massive taxes." Sometimes there are taxes, but many seniors don't realize that federal law provides a powerful exclusion for gain on the sale of a primary residence if you meet certain tests, often referred to by the 2 out of 5 years rule. You generally must have owned and lived in the home as your primary residence for at least 2 of the last 5 years. If you meet the rule, you may be able to exclude a large amount of gain, often up to $250,000 if single and $500,000 if married, filing jointly, from federal tax. That can turn what you thought would be a tax disaster into a manageable event, or even no federal tax at all on the gain within the exclusion. But the leak happens when people sell without planning, or they misunderstand timing after a spouse dies, or they move out too early and lose the residency test, or they don't track their cost basis improvements, or they assume everything is taxable because home prices rose. Before you sell, this is where it is worth asking for advice, because one mistake can cost tens of thousands, and one correct step can save tens of thousands. Let me tell you about Richard, 74. Richard's wife died, and he wanted to move closer to his daughter. He delayed for 2 years because he feared taxes and didn't want to deal with paperwork. When he finally sat down with a professional and learned how the home sale exclusion worked and how his filing status and timing mattered, he realized he could move without the tax nightmare he'd been imagining. Richard's biggest result wasn't just financial, it was emotional. He told me, "I stopped feeling trapped." That's what good information does. It opens doors. Now we're going to move into the fifth tax bill. And I call it a bill because it behaves like one even though it doesn't show up on an IRS form: vehicle registration and DMV fees. Many states and localities offer reduced fees, extended renewal periods, or discounts for certain seniors, veterans, or disabled drivers. Some offer lower-cost state ID cards, some reduce certain fees after a certain age, and some offer transit discounts that can indirectly reduce driving costs. The problem is, these programs are almost never applied automatically. The clerk doesn't always ask your age, the website doesn't always highlight it, and if you don't ask, you pay full price forever. Now, I'm not promising every state has a senior discount on registration. Some don't. Some have it only for specific categories. Some tie it to income. Some tie it to disability. But the cost of checking is low. A 5-minute call or a quick search on your state DMV website for senior discount or reduced fee. If you find something, it repeats every renewal cycle. That's what makes these savings powerful. They're not one time. Now, before we go to the 6th and 7th items, the ones that can change your federal tax bill dramatically, I want to ask you to like and subscribe if this kind of calm, plain English seniors guidance helps you. And stay with me, because the number one secret is coming, and it can reduce multiple categories at once. Seniors who know it often feel like they discovered an invisible lever the system never told them was there. Now, tax bill number 6 is medical expenses. And this is one of the most misunderstood areas for older adults because it doesn't feel like tax relief. It feels like suffering. It feels like receipts. It feels like a stack of pharmacy printouts. And that's why so many seniors ignore it. But under federal tax law, qualifying medical expenses can sometimes be deductible if you itemize and if your expenses exceed a certain percentage of your adjusted gross income. The percentage and details can change based on law, but the big idea is this. For seniors with high medical costs, itemizing can sometimes reduce taxable income more than the standard deduction would. Here's the mechanism that many seniors miss. Medical costs aren't just doctor visits. Depending on the rules and your situation, they can include insurance premiums you pay, certain dental and vision expenses, hearing aids, medical equipment, mileage to medical appointments, and other qualifying expenses. Even Medicare premiums deducted from Social Security can matter in calculating total medical costs. But you only benefit if you track them. If you don't track them, you can't claim them. And if you assume the standard deduction is always best, you might be leaving money on the table. I want to tell you about Anita, 76. Anita had dental work, hearing aids, and high prescription costs in the same year. She assumed taxes were taxes, and she'd just pay whatever the preparer said. Her grandson helped her gather her medical expenses, including items she didn't know counted. When her preparer ran the numbers properly, itemizing reduced her tax bill significantly compared to what she would have paid taking the standard deduction alone. Anita said, "I thought I was just losing money." She wasn't. The tax code recognized her medical burden, but only because she documented it. Now, tax bill number 7 is the one that creates family conflict when it's misunderstood. Property transfers and gifting. Many seniors want to help children and grandchildren. They want to put the house in the kid's name to avoid probate or to protect the home. They want to give money to help with a down payment. They want to do the loving thing. But the tax system has rules about gifts, and real estate transfers can have property tax consequences, capital gains consequences, and Medicaid planning consequences depending on your state and situation. Here is the most important truth. A well-intentioned transfer can create an expensive problem if it's done without advice. You can trigger reassessment in some states. You can create a cost basis issue for your child that leads to a big capital gains tax later. You can affect Medicaid eligibility or create a penalty period if you need long-term care. And you can accidentally lose exemptions that would have protected you as a senior homeowner. Now, I'm not telling you don't help your family. I'm telling you don't sign away property or make large transfers without understanding the consequences. A single consultation with a qualified estate attorney or tax professional, someone who knows your state rules, can prevent a mistake that costs more than the consultation by a factor of 10. Now, we've covered 7 categories, and if you're feeling that mixture of relief and frustration, relief that options exist, frustration that nobody told you, you are not alone. That feeling is normal. And now I'm going to give you the number one secret that ties this entire video together. Here it is. The most powerful retirement tax reduction is not one exemption. It is a coordinated strategy that lowers your taxable income in a way that protects multiple systems at once: federal taxes, the taxability of Social Security, and even Medicare premium surcharges for higher income beneficiaries. And one of the most underused tools for seniors who are charitably inclined and have retirement accounts is the Qualified Charitable Distribution, often called a QCD. If you are 70 and a half or older and you give to charity, a QCD may allow you to direct funds from an IRA to a qualified charity in a way that keeps that amount out of taxable income. This can be powerful because taxable income is the lever that triggers many other leaks. Higher income can cause more Social Security to be taxable. Higher income can trigger higher Medicare premiums through income-related adjustments. Higher income can reduce eligibility for certain assistance programs. Lowering taxable income legally can protect your monthly budget in multiple directions at once. Now, I want to be very clear. This is not for everyone. Not everyone gives to charity. Not everyone is over 70 and a half. Not everyone has an IRA. And you should never give money away that you need for housing, food, or medical care. But for seniors who already give, doing it the smartest way can create a quiet, repeating savings that feels like a permanent raise. And even if QCD doesn't apply to you, the deeper lesson does. Coordination matters, because the biggest mistakes seniors make are not just missing one deduction. The biggest mistakes happen when one decision triggers another cost. A large IRA withdrawal increases income, which increases Social Security taxation, which increases Medicare premiums later, which shrinks the check, which increases stress, which causes seniors to skip care. That's the chain. Coordination breaks the chain. Now let me bring this all back to the real-life outcome we want. Not just saving money, but protecting your peace. When seniors reduce unnecessary taxes and fees, they don't just keep dollars, they keep choices. They keep the ability to say yes to the prescription without fear, yes to the air conditioning during a heat wave, yes to the dental visit before it becomes an emergency, yes to seeing friends without guilt. So here's what to do next, calmly, without overwhelm. Pick one of the 7 categories, just one, and take one action this week. If property taxes are your big burden, call your county assessor and ask about senior exemptions, freezes, circuit breaker credits, veterans exemptions, and deferrals, and ask for deadlines. If taxes surprise you, ask a preparer to confirm you're receiving all age-based deductions and to review whether amendments are possible within the allowable time. If you live in a state that might tax Social Security, verify current rules and exemptions. If you're considering selling your home, ask about the primary residence exclusion and timing. If DMV fees annoy you, check for senior or veteran discounts. If medical costs are high, start tracking them now, not next April. If you're planning to transfer property, don't sign anything until you've gotten advice. And please tell me in the comments, which one surprised you most? Property taxes, state Social Security tax rules, medical deductions, home sale exclusions, DMV fees, or family transfer issues. I want to end with something you deserve to hear. You are not bad with money because you didn't know these rules. The system is complicated on purpose. It is fragmented across agencies. It changes by state and county, and it often rewards people who already have time and help. But you are not behind. You are learning now. You are taking action now. And that single habit, slowing down and checking what you qualify for, can change your retirement more than any lucky break. You're not alone. You still have options. And you deserve to keep more of the money you earned so your retirement feels like security, not a slow leak.